It's Rebound Wednesday, at least for the worst hit stocks of recent days. Volkswagen shares are up 20% from this morning's low, while troubled miner Glencore's gained 7%. Now there are some decent reasons for hope, but the bouncers at this scale are all about having been heavily oversold yesterday and the day before. Both companies have seen their shares more than halve from this year's highs, even after their bounce. Now the broader reason for hope, though, is about the effect of China. Investors have been focused on the dangers that China poses to the world economy since mid-August. The latest manufacturing data lent support rather to the bears. The survey of Chinese purchasing managers came in well below expectations, in fact at the worst level since the aftermath of Lehman's failure. You can see that here. The red line shows the Caixin China Purchasing Managers Index, PMI, and that's the worst since back in 2009. Now that might not sound like good news, particularly since it does away with the faint hope that weak manufacturing recently has been linked to more care being taken after the terrible explosion in Tianjin in August. But instead, the positive news was that the European and US recoveries don't seem to have been thrown off course, at least so far, by the troubles in China. Eurozone manufacturing came in bang in line with expectations, and the US, on the market measure that was out today, was slightly above expectations. Although on this chart, the green line for the US, I've used the longer running ISM survey because the flash September measure isn't yet available on ISM, but it does go back further for the comparison. Now the surveys suggest both in Europe and the US manufacturing still expanding, although not spectacularly. If developed countries have shrugged off the problems that are spreading through the emerging world, then that's great news. It takes away some of the uncertainty that was flagged last week by Janet Yellen as a reason not to raise rates. The divergence, of course, would be that we see, particularly there with Europe, the blue line going up, even as the red line for China is going down this year. Now, unfortunately, it's far too early to conclude that the West has escaped unscathed. China has vast excess capacity in everything from steel to solar panels. Rather than take the pain of restructuring, the danger is that China could cut the value of its currency and ship more of that excess capacity abroad, hurting manufacturing elsewhere. Chinese President Xi Jinping is visiting the US and has tried to reassure his hosts that further devaluation isn't on the agenda. But the currency markets expect the renminbi to lose a lot more value yet against the dollar. Now, international investors think that China is going to have to take losses. Chinese shares listed in Hong Kong now trading below book value for the first time in more than a decade. You can see that in the red line here showing the book value of the Hang Seng China Enterprises Index, which is the Hong Kong listed red chips. Now, in large part, this depressed level reflects the predominance of banks among those red chips. But valuing a stock below book means that investors expect write-offs, in this case of bad loans, but elsewhere of excess capacity. Emerging markets haven't fallen quite so far. You can see that with the blue line. And they're trading at close to 1.3 times book. But you can see just how closely tied they are to what's going on in China. The two move really very closely together. The business of selling iron ore to China just doesn't look as good when Chinese steel mills that buy that iron ore can't find customers. And a lot of emerging markets are in the business of providing iron ore and other commodities to China. The question that investors face is pretty basic. Just how much money was wasted on non-productive assets in the good times and will therefore have to be written off now that the bad times are here? Finding an answer, unfortunately, is much more difficult than asking the question, in part thanks to the opacity of China's economy. But it is pretty clear that many people prefer simply to get their money out now and to worry about the answer later. For those who think that they understand what's going on, this might create an opportunity. But with emerging markets still more expensive than in 2008 on this measure of price to book, and much more expensive on price to earnings ratios, and really far, far more costly than they were after their last crisis in 1998, it's easy to see the appeal of the relatively steady developed countries, that's the green line here, even when they're trading at such a big premium. Investors, though, shouldn't fool themselves. Developed markets may have ridden out the troubles in EM fairly well so far, but if emerging markets are heading for a fully fledged crisis, then they're going to be a lot harder for developed country shares to ignore.